Okay, this is Maj Soueidan. We're here to do the conference. I wanted to kick it off with a really, quick intro in terms of how I'm viewing, how I view investing. It's going to end in that a little bit, but and this is our first virtual conference we're doing, a multi-day conference at MS Microcaps, our Substack. You can visit the Substack at msmicrocaps.substack.com, where we have the first quality index we created that where stocks qualify based on quality and hitting multi-bagger markers. We are finding stocks at inflection points, so the index can be quite volatile at times as you're kind of coming in and out of those periods of inflection. And so should be really a really fun time today. But let me talk about this is important because I'm going to get to the um, um, some of the challenges when you're investing in stocks. But what's one of the biggest investors conundrums? It's can we handle the truth? And what does that mean? And I'm going to show you that in a second here. So let's look at Tom Brady versus Terry Bradshaw. I'm a big Steelers fan, and you look at these two quarterbacks. They had great success, both of them, but they kind of got their different ways. You look at Tom Brady. He was known for his consistency, precision, very strategic, calm, kind of more meticulous. He won 7 Super Bowls, and then you have Terry Bradshaw, who was more of a gunslinger. Didn't really conform to authority too well with Chuck Noll. Led the league in interceptions several times, but he also won 4 Super Bowls. And he had really really big plays. And Tom Brady was known for, although he could throw a long ball, but not really throwing a long ball. Terry Bradshaw was really known for that. But they both had success, and they got to their end results in different ways. So what if I said this year? What if I showed you had $10,000, and I showed you two ways of getting to you had a chance to make one scenario over 30 years turns into $86.7 million, and the other scenario is $8.5 billion in 30 years. Now, which one are you going to choose? Um, a lot of people just say, well, give me that 8.5 billion stack there. But then if we look at this though, now with the assumptions I made here, though, we made an assumption of, okay, well, to get to 86.7 million, let's say it was 25% annually, pretty steady, very little volatility around it, low stress. But to get to the, 8.5 billion, you would at 50% annually, uh, but with lots of volatility. Some years up 300%, some years maybe down 60%. Which one you choose then? And I think that when you look at investor psychology, we might all say, well, they had that 8.5 billion, but a lot of us, we all go through this where we sell at the bottom and we buy at tops. It's a really common problem. When you look at Peter Lynch's Magellan Fund, which averaged about 30% over 13 years, most investors, retail investors in the fund, made only 5% or even lost money. So it's easier said than done. So, and the reason I say that is because success comes in different forms. I mean, you have to really do a gut check once in a while to ask, what kind of investor are you? I mean, can you embrace risk and volatility, to get those returns? Even if you knew, I bet you a lot of us, even if we knew exactly what we were going to, you had a crystal ball, you're going to make this much money in this many years, the volatility will still affect your day to day because you probably wouldn't even believe that fortune teller is a kind of a prediction. So really the key is to do your best to find what path is best for you. And even if you do choose the billion, the 8 point whatever $5 billion pot, how do you give yourself extra chances to be able to feel more confident about that and not make the wrong moves? And that's kind of what but the index really that we created in MS MS Microcaps of the Substack and the MSQI, which is MS Microcap Quality Index. M stands for momentum, S stands for sustainability business, M for Microcaps, Q and I obviously Quality Index, is I'm more of a gunslinger myself. You really could compare. I can't throw a ball that far, football, but I do, you swing for the fences in the stock market a lot, and I love it. It's how I like to invest. And in order to do that, I got to make sure that I'm obviously going to be investing in because I am taking high risk once in a while or often, that I give myself a fighting chance. And I want to give myself some confidence to be able to hold stocks through volatility. And when you start investing in more quality, higher quality companies or higher product turnaround companies, as opposed to pump and dumps and you can make money in these pump and dumps, and you can make money in growth stocks with, crazy PEs and crazy price of sales. But, where's the bottom of those stocks? And they can do well sometimes. I just like to be comfortable that there is a bottom in the stocks I'm buying with a true tangible value, some kind of quality piece to it that makes you feel that way. That feel like I can hold through volatility. But and the other part of the strategy, which is why I love the index, because and I've always said and if you remember my conversation with Bobby Kraft on his podcast, I said that this index is going to be volatile. And even though it's crushing the market when it goes up, when the market comes down, it's going to probably do worse than the market. And that is why I want to, by investing in quality, I give myself chances to be able to at least feel better about the volatility around it and not have my behavior and my emotions get the better of me. And I think that's really, really important. And furthermore, because we're trying to find these stocks that have momentum in terms of business at the right time for a period of time, if we can catch those moments and then sell them, and it's great for those who don't want to have exposure long term to the market, because if you can't handle that volatility, at least our index gives you a chance to capture these multi-bagger moves often by investing in the sweet spot of a growth cycle as opposed to riding it all out. That's the decision you got to make yourself. So I think that's important to understand. I really want to get into that. And that's really the essence of the index. Find these great quality companies that can give us high, powerful returns, but there will be volatility around it like it's going on right now. And because we're investing in quality companies, or the index is comprised of quality companies, we can feel comfortable using it as a hunting ground when the market does pull back. So I hope that puts a little bit of context into the index and why we built it, and a little more around my style of investing and how I've kind of shaped the index to kind of mimic that a little bit.